Hey everyone, thanks for joining us for another deep dive. We got a really interesting report from one of you recently. It's about those new U.S. tariffs and their potential impacts, specifically on India.
Oh, yeah, I saw that one. It's pretty thorough.
Right, so we're digging into the Crisil report. Implications of new U.S. tariffs for India, which is dated, let me just double check, April 4th, 2025, just a few days ago.
Very fresh.
Exactly. So we really want to pull out those key insights, the need-to-know stuff, and maybe uncover a few surprises along the way.
Definitely. Some things in there even surprised me.
I bet. So to set the stage, this Crisil report takes a look at, well, everything, basically, the big picture macroeconomic stuff, and then it gets down to the nitty-gritty, sector by sector.
It's really impressive, actually. And right away, it highlights just how unusual this U.S. approach is. We're not talking about your typical tariffs here. These are calculated, get this, based on the bilateral trade deficit that the U.S. has with each of its trading partners.
Okay, back up for a sec. Bilateral trade deficit. For those of us who don't spend all day thinking about international trade.
Right, of course.
Ah,
Basically, it's the difference between what the U.S. imports from a country and what it exports back. So if they import way more than they export, that's a big deficit.
gotcha. And these tariffs, they're designed to even that out a bit.
That's the idea. Now, we're talking about something called ad valorem duties. That just means the tariff is a percentage of the value of the goods coming in, and these range, get this, from 10% to a whopping 50% on imports from, well, pretty much everyone.
Wow, 50%.
It's a lot, and these went into effect on April 5th.
Okay, so big changes already happening. And for India specifically, how do these tariffs play out?
So for India, the additional duty is 26%, and that kicked in just yesterday, April 9th.
26%. Now, I was looking at the report and points out something interesting, that 26% for India is actually lower than what some other Asian emerging markets are facing.
Oh, yeah. Countries like China, Vietnam, Bangladesh, even Thailand and Indonesia, they're all getting hit a bit harder, at least in terms of this new tariff. The report even includes a chart, really helpful visual that shows these reciprocal tariffs side by side.
I saw that, makes it really clear. But I also noticed a little caveat there. While 26% might seem lower at first glance.
Ah, you caught that, yes. It's important to look at the effective tariffs. That's where things get more complex.
Effective tariffs, meaning
Meaning that the 26% is tacked on top of any existing tariffs that were already in place for specific countries and goods. So India might have some pre-existing tariffs on certain items, and now those are compounded by this additional 26%.
so the total impact could be much higher than 26% for some Indian goods.
Exactly. And that's where things get interesting because it creates this uneven playing field. Some goods from India might be more competitive now, thanks to that relatively lower 26%, but others, well, they might not fare so well.
Gotcha. It really is about looking at the specifics. Okay, so this whole idea of setting tariffs based on the U.S. trade deficit, that seems like a pretty direct way to try and reduce imports and bring that deficit down.
It is, and the report points out a few key things here. First, there are some big exemptions. Certain goods, things like copper, pharmaceuticals, for now at least, and semiconductors, they're not subject to these new tariffs.
That's a relief for those industries.
Definitely. And the exemptions don't stop there. Bullion, energy, certain minerals that the U.S. just doesn't have domestically, those are also excluded. And get this, these exempt categories, they made up almost a fifth of India's goods exports to the U.S. last year. That's according to the report, at least 17% in 2024.
Wow, that's a big chunk. So it's not all doom and gloom, but there are also some exceptions to these new tariffs, right? I think the report mentioned those 25% tariffs on steel and aluminum and autos and auto parts.
Yeah, those are sticking around. Separate from all this new reciprocal tariff stuff, we're talking about steel and aluminum articles and automobiles and auto parts. Those are still facing that 25% tariff that was already in place.
Okay, so we've got the basic tariff structure down. But what does this all mean for India overall? What's the big picture?
Well, the report highlights two major things that will really determine the ultimate impact. First, how long do these tariffs actually last? And second, what happens with those ongoing bilateral trade agreement negotiations between India and the U.S.?
Right, those are aimed at getting at least the first part of an agreement done by fall 2025.
Exactly. But it's not just about the U.S. and India. What other countries do in response to these U.S. tariffs, their negotiations, that'll be a huge factor too. The whole global trade environment is in flux right now.
Absolutely. And the report talks about this increased economic and trade uncertainty. Businesses, they hate uncertainty. They don't know whether to invest, whether to hire.
It makes planning incredibly difficult. The report even points to this thing called the World Uncertainty Index. And guess what? It's elevated. People are nervous. And this whole tariff situation is just adding fuel to that fire.
So we've got the tariffs, but the uncertainty they create, that's almost as impactful.
Almost more so in the short term. Businesses might hold back on investing, on making big decisions until they have a clearer picture of what the trade landscape will look like.
And it's not just about investing in, factories and equipment. The report also talks about increased capital flow volatility and exchange rate fluctuations. It all gets pretty complex.
It does. It's about investor confidence. When things feel shaky, investors tend to pull their money out of what they see as riskier assets, often in emerging markets like India. They call it safe haven sentiment. Basically, investors run for cover to what they perceive as safer bets. And the report actually points to some hard numbers here. Between October 2024 and March 2025, a significant chunk of foreign investment left India. We're talking about $18.9 billion slowing out, compared to a $21.6 billion inflow in the 6 months before that.
So real money moving around based on these perceived risks.
Exactly. And it underscores the historical significance of these U.S. tariffs. The report cites S&P Global, and they say these are the highest U.S. tariffs since the 1930s. It really puts the magnitude of this shift into perspective.
The 1930s. Wow. That puts it into a whole different light. And this isn't happening in a vacuum, right? India's economy is increasingly intertwined with the U.S. and Europe.
Very much so. The report highlights that their combined share of India's goods exports has been steadily rising. In 2024, it hit 36%, up from 31% just 5 years earlier in 2019.
So any slowdown in the U.S. or Europe, that's going to have a ripple effect on India. Less demand for Indian goods if those economies are struggling.
Precisely. And then you've got the China factor. These higher tariffs on Chinese goods, they might actually exacerbate some of the challenges China's already facing.
Like what?
Things like excess production capacity, they're making more than they can easily sell, and deflationary pressures. That basically means prices are falling, which can be bad for an economy. So what happens? Well, the report suggests that China might start diverting its exports, looking for other markets to offload all those goods, and guess where some of those goods might end up?
India.
Bingo. India, where China already accounts for about 15% of all imports. That's a pretty big chunk.
Yeah.
This could create a ton of uncertainty for Indian producers who suddenly have to compete with a flood of potentially cheaper Chinese goods right in their own backyard.
So more competition at home on top of everything else.
Exactly. And the report points to a potential early warning sign of this happening: India's recent imposition of safeguard duties on some imports.
Remind me what safeguard duties are again.
They're like temporary tariffs, a way to protect domestic industries from a sudden surge in imports. It's a defensive move, and the fact that India is doing this could indicate that this risk of Chinese goods flooding the market is already starting to materialize.
So with all these factors in play, I'm guessing the report doesn't paint the rosiest picture for India's economic growth.
You're right. It suggests there might be a downward revision to that 6.5% GDP growth forecast for this fiscal year. Slower global growth, those U.S. tariffs, and weaker prospects in other key trading partners like the EU and the Asia-Pacific region. It all adds up.
And just to underscore it, the report reminds us that the U.S. is India's biggest export destination, accounting for something like $81 billion in goods exports in 2024.
Yeah, losing a good chunk of that would be a blow. However, the report does provide some important context. It highlights that India's economy is, to a large extent, driven by domestic demand. And there are policy levers, things the government can do that might offer some cushioning.
Like what kinds of things?
Well, they mention the potential boost to consumer spending from things like interest rate cuts. If borrowing gets cheaper, people might spend more. There's also the possibility of income tax relief, putting more money back in people's pockets. And stronger agricultural incomes would also help. And then there's the government's own spending, especially on infrastructure and development projects. That can keep the economy humming, even if private businesses are hesitant to invest.
So not all bad news. Okay, so that's the overall impact. But the report doesn't stop there. It dives into India's buffers, those things that might help it weather this storm. And the first one they highlight is the rise of services exports.
Yes, this is key. Services are becoming a bigger and bigger part of India's export picture. They're now around 47% of total exports, way up from 31% back in fiscal year 2012.
So more than just goods going out, think IT services, consulting, that kind of thing.
Exactly. And the idea here is that services exports might be a bit more resilient, more insulated from the disruptions in goods trade. And the report actually has some numbers to back this up. In the first 11 months of the last fiscal year, merchandise exports were basically flat at $395 billion. But services exports, they jumped up by over 14%, hitting $355 billion.
That's a pretty stark difference.
It is, and it suggests that this growing focus on services could act as a buffer, a kind of safety net, against shocks specifically hitting goods trade.
Okay, so services are one buffer. What else does the report point to?
Well, they highlight India's overall financial health, particularly its external indicators. This is all about how vulnerable a country is to global shocks. And the report notes that India is in a much better position now than it was in the past. Remember a few years back when everyone was talking about the fragile five economies?
Vaguely. Remind me.
It was this group of emerging markets that were seen as highly vulnerable to global financial shifts. India was one of them. But the report argues that India is far less fragile now. Its current account deficit, the level of external debt, the amount of short-term debt, the number of months of imports that its foreign exchange reserves can cover, all of these indicators are much healthier now compared to those turbulent times.
So basically, stronger fundamentals to help it ride out the storm.
Exactly. And the report also mentions the rupee. It's depreciated, meaning it's lost value against other currencies, but in a relatively orderly way despite those capital outflows we talked about earlier. That suggests a degree of resilience that India's not panicking.
Okay, so strong fundamentals, a growing services sector. Anything else in India's arsenal?
Well, the report talks about the potential of domestic policy to help boost growth. They mention the possibility of the Reserve Bank of India cutting interest rates. That could make borrowing cheaper and stimulate economic activity. They're predicting cuts of 50 to 75 basis points this fiscal year.
And lower inflation overall, especially for food, would also help. People would have more money to spend on other things.
Absolutely. And in a world where protectionism seems to be on the rise, the importance of domestic policy can't be overstated. The report emphasizes this idea of rapid deregulation, which has been a big theme in the economic survey and the union budget recently. The idea is to make it easier to do business in India, to attract investment and boost domestic growth.
Okay, so that covers the overall impact, the buffers, the potential policy responses. But now let's get into the specifics. The report does a deep dive into individual sectors and how they might be affected. Starting with, let's see, pharmaceuticals.
Right. For pharma, the report actually gives a neutral outlook, at least for now. And the reason for that is pretty simple. Pharmaceuticals are currently exempt from those additional tariffs.
That's a big deal.
It is. And the report highlights a few of India's strengths in the pharmaceutical sector. It's cost competitive, it has a lot of US FDA-approved manufacturing facilities, and it has a skilled workforce. Those are all hard to replicate quickly. However, there's a caveat. If those tariffs were to be imposed at some point down the line, it could put pressure on both growth and pricing, simply because India relies heavily on the U.S. market.
Yeah, the report says something like 32% of India's pharma exports go to the U.S. So that exemption is a big deal for now. What about textiles and apparel?
For textiles and apparel, they're actually giving a marginally favorable outlook.
Marginally favorable. How come?
It's all relative. The new tariff rates on India for textiles are lower compared to some of its biggest competitors, places like China, Vietnam, Indonesia, and Bangladesh. So in that sense, India's in a slightly better position.
So they might be able to grab some market share from those competitors facing higher tariffs.
Exactly. However, the report points out that Indian manufacturers exporting to the U.S. might see their profit margins squeezed a bit.
Why that?
They might not be able to pass on the full increase in costs to their U.S. customers. So yeah, they might sell more, but they might make a little less per item.
Right. That makes sense. And I remember the report also talked about this buildup of inventory in the U.S. Like, there's a lot of unsold stuff sitting in warehouses.
Exactly. And that provides some stability in the short term, but it could also create inflationary pressures down the line. If those goods eventually hit the market, prices might go up, and that could dampen consumer spending.
So a bit of a mixed bag there. And then there's the whole wild card of what China does. If they start redirecting their textile exports, things could get even more competitive.
Oh, absolutely. The report also mentions this possibility of U.S. importers looking to shift their sourcing to countries that have lower base tariffs. They specifically mention Turkey and Honduras.
Interesting. So Even though India might have a relative advantage, there are other countries waiting in the wings.
That's the reality of global trade. But despite those challenges, the report does point out some of India's strengths in this sector. The fact that it's the second largest cotton producer globally, that it has a presence across the entire value chain from growing cotton to making clothes, and that its labor costs are relatively low, those are all advantages.
So still some reasons to be optimistic, and the
Right.
report even suggests that this whole situation could actually speed up negotiations for a free trade agreement between India and the U.S.
It might. It could incentivize both sides to get a deal done to provide more certainty and stability in the long run.
Okay, so textiles, a bit of a mixed bag. Let's move on to gems and jewelry.
Ah, yes. Not such a rosy picture there, I'm afraid.
The report is pretty pessimistic about this one.
It is, and there are a couple of main reasons for that. First, a big chunk of India's gems and jewelry exports go to the U.S. We're talking about 37% in 2023. So any hit to U.S. demand, that's going to be felt in India. And the second reason is that spending on gems and jewelry, it's often seen as discretionary. People don't necessarily need those things. They buy them when they feel good about the economy, when they have extra cash. So in a downturn or when prices go up, that's one of the first things they cut back on.
Right. It's a luxury, not a necessity. And the report says that demand in the U.S. is already pretty weak.
It is. And these new tariffs are only going to make things worse. As the cost of those gems and jewelry goes up, consumers are going to be even less likely to buy them. And the report points out that the volume of gems and jewelry exports has already been declining in recent years.
Not a good trend.
No, it's not. And because India is so reliant on the U.S. for this sector, businesses might really need to think about diversifying their markets, finding new places to sell their goods. Or they might need to focus on higher value items, things that are less sensitive to price fluctuations.
Makes sense. Okay, so gems and jewelry, definitely a sector to watch closely. What about smartphones?
Smartphones are interesting. The report gives a marginally favorable outlook for this one.
Okay, marginally favorable. Explain.
So the reason for that is that the new U.S. tariff on smartphones coming from India is lower than the tariffs slapped on its biggest competitors. We're talking about China and Vietnam primarily.
So Indian-made phones will still be more expensive in the U.S., but maybe not as much as Chinese or Vietnamese phones.
Precisely. The report even uses the example of the iPhone 13 Pro. Even with the new tariffs, it's likely that the Indian-made version would still be cheaper than the Chinese-made one in the U.S. market.
So there's still a price advantage.
Yeah.
And that could lead to some shifts in production. Maybe some companies will move some of their manufacturing from China to India.
The report suggests that could happen in the short term, but it also flags some potential medium-term risks.
Like what?
Well, if inflation in the U.S. continues to rise, that could hurt overall consumer spending. People might just buy fewer phones, period. And then there's the possibility that other countries that India relies on for smartphone components, might increase their own export duties.
So India might get hit with higher costs on the things it needs to make smartphones.
Exactly. It gets complicated really quickly. And
Yeah.
then there's the potential for some of those big international brands to shift their focus away from India, maybe to manage surplus capacity elsewhere.
So while there's a short-term opportunity, there are also some longer-term challenges to consider. Okay, moving on. Agriculture.
Agriculture.
Mm.
Another one where the report gives a marginally favorable outlook.
Marginally favorable again. What's the logic there?
The report makes an interesting distinction between agricultural commodities and manufactured goods. When you slap tariffs on agricultural products, it's less likely to make the U.S. self-sufficient in those things. It's more likely to just shift where they get those products from.
So instead of buying rice from China, maybe they buy it from India.
Exactly. But the overall demand for food, that's pretty stable. People got to eat. So these higher tariffs, they'll probably just lead to higher food prices in the U.S. And India, well, it stands to benefit in a few specific categories where its competitors are getting hit harder. Shrimp and rice are two big ones.
I remember reading about that. Let's start with shrimp.
Okay, so for frozen shrimp and prawns, India already has a big chunk of the U.S. market. Almost 40% of U.S. imports come from India. But Ecuador, they're gaining a tariff advantage in this new scenario. So India might face some short-term challenges, but the report thinks it could regain that market share, especially from competitors in Southeast Asia. And there's also potential for India to increase its shrimp exports to China.
So maybe some reshuffling of where those shrimp go.
Exactly. Then you have other types of shrimp and prawns. India's tariff advantage there isn't as big, but it's still better than a lot of its major competitors. So that's a good sign for the short term, but The report flags Canada as a strong competitor in this segment.
Okay, Canada. Got it. And what about rice?
Rice is interesting. India already has about 26% of the U.S. import market for rice. And now, with those higher tariffs on Thailand and China, India's position looks even better. The U.S. isn't India's biggest rice market right now. It's actually only the 10th largest. But the U.S. offers higher prices for rice, so it's an attractive market.
So even though there might be some near-term challenges, the report seems optimistic about India's prospects in the rice market over the short to medium term. Okay, agriculture. Let's see, what's next? Auto components.
Yes, auto components. The outlook there is marginally unfavorable, according to the report.
Marginally unfavorable. Okay, break that down for me.
So the U.S. has been a really fast-growing market for Indian auto component exports. India's gained something like 7 percentage points of market share there in just 8 years. That's a big deal.
So what's the problem then?
Well, the good news is that the Indian auto component industry's overall exposure to the U.S. market is still relatively low. Only about 3.5% of its revenue comes from U.S. exports. So the direct impact of these tariffs might not be huge.
Okay, that makes sense.
But here's the concern. The report points out that certain types of components, specifically gearbox and transmission components, are more heavily reliant on the U.S. market, and those could be hit harder.
Right, because there are more specialized, maybe fewer alternative markets for those.
Exactly. And the biggest risk here is losing market share to Canada and Mexico. They have that USMCA trade agreement, which gives them a big advantage. They might only have to pay tariffs on the non-North American content of their exports to the U.S.
So they can potentially undercut Indian companies on price.
That's the worry. The report suggests that Indian companies might need to focus more on supplying directly to car manufacturers, those OEMs, and on the replacement parts market. Those might be less vulnerable to this tariff situation.
Okay, so some potential strategic shifts for Indian auto component makers.
Yeah.
And I remember the report also mentioned the risk of Chinese components flooding the Indian market, being dumped at super low prices because it can't sell them in the U.S. anymore.
Right, that's always a concern when you have these kinds of trade disruptions. But the report thinks that risk is relatively low for auto components, mainly because India has a lot of local production. They're not as reliant on imports from China for these things.
So some insulation there. Okay, auto components. Let's talk about chemicals.
Chemicals, another one where the outlook is marginally unfavorable.
Okay, second verse, same as the first, sort of. What's going on with chemicals?
Well, here's the thing. On the surface, it looks okay. India's new tariff rates for chemicals are lower than those of its competitors, so that's a plus.
Sounds good.
But, and there's always a but, the report is really concerned about those high tariffs on China. They think it could trigger a price war in markets outside the U.S. Basically, Chinese chemical producers might start selling their products at really low prices in places like India just to get rid of them.
So more competition for Indian companies at home.
Exactly. And that could squeeze their profit margins, even if their exports to the U.S. are relatively unaffected. The report doesn't think there will be a big drop in the volume of Indian chemical exports to the U.S. in the short term, but they do anticipate pricing pressure.
So selling the same amount, but making less money per unit.
Right. And there is one potential bright spot. Specialty chemical manufacturers in India, they might actually see some gains in the U.S. market, but overall, it's a cautious outlook.
And the report points out some other things to watch out for. The U.S. has a technological advantage in many areas of the chemical industry. They also have better access to raw materials. And then there's the risk of China redirecting its chemical exports to places like India, further adding to the competition.
All factors to consider. And the report also mentions that U.S. importers might start looking to other South Asian countries with similar tariff levels to India, places like Japan and South Korea.
So even though India has a tariff advantage, it's not necessarily a guaranteed win. Okay, chemicals. Let's see, photovoltaics is next. Solar panels and all that.
Yes. And for photovoltaics, the report gives a neutral outlook.
Neutral. Okay, how come?
It all comes down to exemptions again. Like pharmaceuticals, the photovoltaic sector is currently exempt from those new U.S. tariffs.
That's a big relief.
It is. And the report argues that India is actually in a pretty good position to export to the U.S. compared to its competitors, mainly China and the ASEAN countries. There are a bunch of reasons for that. The U.S. has banned imports from the Xinjiang region in China, and it has a 60% tariff on solar PV inputs, which hurts Chinese producers. There's also an ongoing anti-dumping investigation into imports from ASEAN countries, which could lead to even higher tariffs.
So India's kind of dodging a bullet here.
In a way, yes, and India's own capacity to manufacture solar modules and cells is growing rapidly. They're also price competitive compared to US and ASEAN producers.
There's lots of things going for them.
There are, but the report does highlight a couple of things to keep an eye on in the medium term. First, the US is trying to grow its own domestic solar industry. So eventually, they might need fewer imports. And second, the US has a quota on how many solar cells and modules it will import each year. After that quota is reached, tariffs kick in.
So even though the current situation is favorable,
Right.
things could change down the line.
That's the takeaway. It's a sector to monitor closely.
Okay, photovoltaics. Let's wrap up with steel and aluminum.
All right, steel first. The outlook there is neutral.
Neutral. Okay,
Yeah.
fill me in.
The main reason for the neutral outlook is that Indian steel producers don't really rely on global trade that much. They're mostly focused on the domestic market. And that domestic market is strong, demand is high, and India already has safeguard duties in place to protect its steel industry from cheap imports. The U.S. had already imposed tariffs on steel, which has actually helped U.S. steel mills. They're operating at higher capacity now. And India is actually considering its own safeguard duty on flat steel imports to protect against dumping. So the bottom line is that the Indian steel industry is likely to be more influenced by what's happening within India than by these new U.S. tariffs.
So relatively insulated. What about aluminum?
Aluminum is a bit different. The report gives a marginally unfavorable outlook there.
Okay, why is that?
Well, unlike steel, exports make up a big chunk of India's aluminum production, and while the direct impact of the U.S. tariffs might be limited, there are other concerns.
Like what?
Well, the report talks about this potential realignment of global supply chains. Basically, with all these tariffs flying around, companies are going to be rethinking where they get their aluminum from. And that could increase competition in markets outside the U.S., markets where India currently sells its aluminum.
So more competition, potentially lower prices.
Exactly. And then there's the possibility of retaliatory actions by other countries. They might slap their own tariffs on U.S. goods, and that could further disrupt global trade.
It's a real domino effect.
It is. The report also points out that Canada, which is a big aluminum exporter to the U.S., is going to be hit pretty hard by these tariffs. And the U.S. might actually start importing less aluminum scrap, which is something that India relies on, so that's another potential challenge. And then there's always the China factor. With their own exports to the U.S. facing higher tariffs, they might start flooding other markets, including India, with cheaper aluminum.
So it's a combination of factors that are making the outlook for aluminum a bit more pessimistic.
It is. But the report does note that Indian aluminum manufacturers have one big advantage. They're vertically integrated. That means they control more of their supply chain, which can help them keep costs down.
So that's a potential buffer. Okay, we've covered a lot of ground here. We've looked at the overall impact of these new U.S. tariffs. We've explored India's buffers and potential policy responses, and we've done a sector-by-sector deep dive. So for our listeners, what's the key takeaway?
I think the main message is this. While these U.S. tariffs present real challenges, they're not necessarily a disaster for India. India's economy is more diversified than it used to be, its services exports are growing rapidly, its financial fundamentals are strong, and the government has some tools it can use to support growth. But the impact will vary considerably across different sectors. Some will benefit, some will be hurt, and a lot will depend on how things play out in the global trade arena.
And on that note, here's a final thought for our listeners to chew on. How might these shifts in global trade, driven by these tariffs and other factors, change not just international commerce, but also consumption patterns and investment strategies within India? What new dependencies or opportunities might emerge for Indian businesses and consumers as the world adjusts to this new reality? These are big questions, and they're worth thinking about carefully as we all navigate these uncharted waters. Thanks for joining us for another deep dive. We'll see you next time.